results. Revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
The Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off session low, still down about 1% on the day for a little more than 4 pennies.
For credit spreads, this actually falls into the intermediate level of presentations, because if you don't really understand buy-in calls and buy-in puts, then spreads is one step more advanced than that, and you might be lost. But what we want to do,
our members are familiar with spreads and so forth, so I don't think you're going to have a problem there, Jim.
Terrific. All right. So anyway, real quick review of credit spreads. There's 3 things you got to know. I'm going to just real quickly show you a credit call spread. So here, the underlying stock is assumed to be at 50, and we're going to sell the 50 call, buy the 55 call for a net debit of $1.70. And, you know, if everything expires worthless at expiration, then you make the $1.70. Your expiration break-even point is $51.70, and if this stock is taken over, you know, $200 a share tomorrow, your maximum risk is $3.30. Okay, now we're not going to be holding spreads to expiration. We're going to be talking about price behavior prior to expiration, but nevertheless, you know, this is the basics. Now, a bull put spread or a credit put spread is pretty similar. Now here I'm selling the 50 put, buying the 45 put. Okay, I'm doing this for $1.60 credit. So if the stock goes up at expiration, everything expires worthless, you make the $1.60. If the market goes down, then your break even would be 50 minus $1.60 or 48.40. And your maximum loss would be $5 minus the $1.60 or $3.40.
Right, $5 being the separation between the long and the short on that one.
Correct.
Right.
Just to go back real quickly, always know that, and I'm going to actually compare some $5 spreads to a $10 spread in the guts of this presentation coming up. But Seth basically just said the important thing. Know the maximum value of the spread, which is the distance between the strikes. So it's a 5-point or $5 credit spread.
Right.
You receive $1.60 net credit when you put it on. So the most you could lose would be $3.40.
Right.
All right. Now, when you trade credit spreads, you should be aware that, you know, we're going to be talking prior to expiration. Well, I'm not suggesting you put on a 3 or 4 week credit spread and hold it for the full period of time. We want to trade these things. We might hold them for a day or two. I mean, but we're basically worried about how the price changes as the underlying price changes, when time passes, and if the volatility level changes. And the questions you have to ask yourself is, how does your spread make money? Some spreads make a good amount of money from time decay and less from stock price movement. Other spreads make most of their money from stock price movement, and they might make a little from time decay, or they might lose from time decay. The second question is, the way your spread makes money, is that consistent with your forecast? I mean, if you have a bullish forecast and you think the stock's going to move, then you want a spread that makes money with stock price movement. If you're sideways on the market, then you want a spread that makes money from time erosion. If you think volatility is going to go down, then you want a spread that makes money from declining volatility. And regardless of what you think, we can't be pig-headed. We have to go into the strategy, into the trade, knowing that we can be wrong, and if we get to a certain point, then we're not going to argue with the market. We're not going to, say just a little bit more. Then we're going to just say, hey, bad trade, we're out of here.
Right.
Very important concept. Okay, so now the guts of this presentation is really about how credit spreads behave prior to expiration. But the most important thing is to first talk about the price behavior of one option. Then we'll talk about how a spread changes. So, and the analogy or the thinking process is the same for spreads as it is for individual options. But the concept is, here you're starting assumptions. The stock is at $50 a share. Today is 28 days to expiration. And I'm just going to look at two different call options for simplicity, a 50 call and a 55 call. Okay?
Right.
Now notice, in order to fill in where those question marks are, you've got to have a forecast for the stock price. Now in this case, we think the stock's going to go up $1.
Right.
Highly simplified. And we think that this is going to happen today, so that the time theoretically is unchanged.
Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.